Hello, thank you for joining me for this December 1, 2023 edition of FedWatch. I want to cover three aspects of our responsibility here with FedWatch. One is the PCE data came out. Two, I want to reference back to some CPI numbers to highlight a point. And three, I took a look at the employment numbers to see if we could get an idea of, will the Fed lower interest rates in 2024, which is what we are expecting that they will do. So I think that tips my hand in terms of a bias. We think they're going to be lowering it. So you have to be aware that I'm looking for things that will support my position. So every analyst has a bias. I'm just declaring mine right now. But the good news on the PCE price deflator point or front is that the inflation rate's running at higher, about 3.5%. But that's down from 3.7%, all of which means the numbers are moving in the direction that the Fed needs to see them moving. They allude to the fact that the PCE price, personal consumption expenditure data itself for October showed some softening in consumer activity. And indeed it did. When we looked at the September to October change in the personal consumption expenditures, total nominal dollars, it was softer than we have seen in recent years. In fact, it was right in line with softness we saw in 2015, 16, and 17. And you may recall those are the recession years that we are using as a paradigm for 2024. So to see that softness in the PCE data consistent with that paradigm, I think is good in terms of our outlook. It isn't good in terms of the economy slowing down, but if you know it's coming, then you do something about it, obviously. And I mentioned the consumer price index. What was interesting there, as far as I'm concerned, is the fact that inflation is coming down as measured by the CPI, whether you look at core or whether you look at the overall CPI. But when they exclude food and fuel, which is what you saw with the PCE price deflator, it actually goes up because food's up only 3.3% and energy costs are down 4.5%. So focusing on the traditional core, in my opinion, is a bit misleading right now. The overall core number is higher because the food and energy are lower, and it's being driven higher by shelter costs. That's a biggie, up 7.0% year over year. And that includes rents and rental equivalency for homeowners. And that's a big part of the drive. But what really caught my eye was also motor vehicle insurance was up 19.2%. So a lot of the softer service side of the economy seems to be driving this. And that's going to make a tougher nut, as we've talked about before, for the Federal Reserve to accomplish their goal. I mean, if inflation was being driven by commodities, it's a fairly straightforward play. But commodities, according to the CPI, were only up 0.4% year over year. So the problem is in insurances and in rents, and that's a tougher nut. Third component that I wanted to talk to you about was employment. And again, it's good news in terms of wanting to see the Fed lower interest rates. And the good news there is while October was a record high number of people employed in the United States, the rising trend in employment is definitely cooling off. It's really losing a lot of steam. The 112 has been running 1.8 to 2.0% for the last 3 months, which is normal. And I think it's going to be slipping down below that because when we ran the indexing on the data, you can see it's like leveling off. It's just capping off. So if the Fed sees that, I think it's going to make it even easier for them to give us some interest rate decline in 2024. The unemployment rate has come up. It's at 3.6%. We use not seasonally adjusted data. That's up from 3.1% low in April. So that's incrementally moving in the right direction. And we have just under 1 million more people unemployed now in October than we did in that April low. So the Fed's got to be looking at all this and saying, okay, it's beginning to creak, it's beginning to move in the right direction. You throw on top of that inventories are high, um, manufacturing is in negative territory. I think we're building a pretty good case for seeing some interest rate decline in 2024. Next Fed Watch, I'm going to come in and we'll talk a little bit about the potential magnitude of Fed funds decline in 2024. For now, these are the good tidings for as we head into the Christmas season. And thank you for watching this edition of Fed Watch.